That's right. All right, very good. Well, we're going to go ahead and get started. So I'm going to start by introducing myself for those remote or those I didn't get a chance to speak to beforehand. I am Lori Everhart. I am the Director of Development here at the Community Foundation of Northeast Iowa. And we are want to welcome you to our final Professional Advisor event of 2021. Hard to believe that we're looking at the last one already. We're very happy to be here, as many of us are here together in person at our offices today, as well as those who are joining us remotely. So thank you so much for being a part of it. Today's session, I just want to make sure everyone knows, does have continuing education credits available. I'll be sending out a follow-up email. So for those who need the CFP credits, to send, to get that information from you if I don't already have it, and also to give you the number if that's the credits that you need. I think everyone who is here in person got indicated on the sign-in sheets, and for those who are joining remotely, when I send that follow-up email, you are welcome to send the information that I will need back, especially for the CFP credits, to get you on that list for those credits. So are very excited, as I said, to be back here today and having our final presentation. Before I introduce Aaron, I want to just remind our remote participants to go ahead and please mute yourselves just to minimize any background noise. And we'll have some time at the end for questions. And if you are remote, there is a hand raising function in Teams that you can use to indicate if you have a question, or you can turn your video camera on and wave at me until I notice that you're there wanting to ask a question. But either way, we'll be sure to get those questions answered for you. So speaking of Aaron, I'm going to go ahead and introduce him. Aaron Sanas is a private wealth advisor and managing partner with Discerning Wealth, a private wealth advisory practice of Ameriprise Financial Services, LLC. He graduated from Luther College in Decorah with his BA in economics. As a Wartburg grad, I didn't know that, so I don't know. We'll have to arm wrestle later about all of that.
We're not talking football, so it's
no. Okay, yeah, well, yeah. You don't want to talk football, I know. Earning his CFP designation, he has numerous years of experience in the financial world, the last 30 of which have been with Ameriprise, starting as a training advisor, moving up to district manager, a managing principal, and becoming financial advisor in 2002. As a private wealth advisor, some of Aaron's areas of focus are charitable giving, estate and tax planning strategies, saving for education and retirement. And another focal point for Aaron is Christian financial strategies. And this is very present in one of his many designations, the CKA, or Certified Kingdom Advisor. Aaron has been recognized in the Ameriprise Circle of Success 4 times, from 2015 to 2017, and again in 2020. He is associated with $1 Million Roundtable, the premier association of financial professionals, a global independent association of the world's leading financial and insurance professionals. He's also part of the Financial Planning Association, National Association of Insurance and Financial Planners, and the Society of Financial Service Professionals. Aaron is also an active member of the community, serving on the Blackhawk County Estate Planning Council, the Investment Committee here at the Community Foundation of Northeast Iowa, and as a Finance Committee member for his church, Nazareth Lutheran. Aaron is married to his wife, Christy, for 30 next month. Together, they have 3 boys, Jack, who's 25, Drew, who's 22, and Chase, who is 18. The last one out of the house, or still?
Senior.
All right, excellent. He loves spending time with his family and his friends, loves to travel, listen to music, and attend concerts, and he enjoys golfing and being outdoors as well. So please help me in welcoming Aaron.
Well, I have to admit, I don't know if I'm as qualified to talk to this group, because all of you know as much or more than I do on these items. I was asked actually to participate, like I did before a couple of years ago when we were open. And I thought when I said yes, I was going to be on a panel discussion like I was once with Mark Rollinger and a bunch of other people, because they said they were going to have 4 of these. And I said, well, yeah, I'll do that. And then all of a sudden I got the invite and said, well, we'd like to know what your presentation is. So it's like, oops, So then on charitable giving, so I thought, what would be something that I actually could bring to the table with everyone here that is already involved in charitable giving, and because we've got foundation people, we've got CPAs, we've got people in the business and at the foundation here. So what do we already know? What do we need to know? Because we have the record year of giving here at the foundation. So what do we need to know about what do we need to know about charitable giving? So what I thought I'd do is let you into our world a little bit. This is my 30th year with Ameriprise. I have not worked for anyone else. And so what have I learned in 30 years? And I will tell you, it's really about what financial planning can do. So I thought I'd rename this presentation on tax planning and charitable giving called Financial Planning Opens Opportunities. And this can be a little bit interactive on the front part here, because I want us to all share, and hopefully not only can you get ideas from me, but also from everyone in the room. And so we'll get started. So our agenda is going to cover 3 areas at about 200 miles an hour. So, really the psychology of this, and I think that's important to understand as we dig into clients. I'm going to talk to you about comprehensive financial planning in all the areas, and how we can find opportunities there, and then actually to discuss then what are some. So I think it would be kind of interesting. So the first one is, first thing I'm going to do is make it interactive. So a real big question here is, why do people give? So why do people give to charities? Anybody?
Want to give back for what they feel they've been blessed with?
Yeah, giving back, absolutely.
Make a difference.
Make a difference? Yes. Anybody else?
Give to an organization that has similar values.
Giving to an organization that has similar values. You bet, that could do it. Yeah. Anybody else?
Same tax.
Saving taxes.
Same.
Absolutely. Absolutely. Yeah, and I think that's important. And so think about this. I think it's our job, and you're going to hear, we got to get inside people's heads to find out really what they want. And so that's what we're gonna talk about. So just in summary, yeah, what do people give? Well, leaving a legacy, and I think that's something that everybody wants to do, either with their family or in the community. It can be for selfish reasons, but giving money charitably for selfish reasons is also helping people learn good values about money and giving away. And one of the things I've experienced is, of all the people that give a lot to the church or to charities, they always have good results about that. And our most successful people that I know give a lot of money. I don't know how that works, but it does. And so it's a big part of your financial plan. You can influence society, you can help others, create a sense of belonging, and yes, taxes. And as I've been on the board and on the finance committee for the Community Foundation, there's a concern that what happens if you don't have the tax credit? Would people still give? And I think, to the people in the room around foundations, getting inside of here of looking for opportunities, a lot of times we've got to help people find them. So why don't people give?
Maybe it wasn't modeled for them growing up. They didn't see their parents give.
Yeah.
Somebody else will do it.
Somebody else will do it. Yeah.
Not knowing if they have enough to give somebody and still meet their own needs.
Don't know if they have enough. Oh my gosh, yes. Yes, absolutely.
Maybe they don't know how to get started doing it, how to start, giving.
Yeah. Yeah,
They're not asked.
they're not asked. Yeah. Yes, I think that's big. And I think that's obviously, these questions here would be good to even ask the clients or the people that you're in front of and get people thinking about this stuff. And so, yeah, the 2 big things that I saw was, and you guys said it, they don't know if they can afford to give. When I got my CKA, and it's just about, how to help people give money charitably to churches or foundations or whatever. One of the things that I found in my training is that most millionaires and billionaires don't know how to give because they actually don't know how much they need, which is kind of a crazy thing. So having a lot of money doesn't mean that you are that confident. The other thing, which is why we're here, is they're not aware of the strategies appropriate and available to them. They don't. And so you can't implement a charitable remainder annuity trust or a unit trust just off the cuff. There's a lot of learning and things that go on here. And I think that's the key part here is why we're talking about financial planning. Because I would say that all of us in here are on the same team when it comes to helping clients. Because there is an abundance of business out there for everyone. But it actually needs the accountant, the attorney, the advisor, the foundation person, and then family members to get involved. Sometimes for people to, it's got to become their ideas. Adults don't like to be told what to do; they have to learn. And so, I think if you really want to have a big ask for someone, well, I think some of these an integrated approach, having everyone working together to help the client, is how you're going to get it done. The best tax strategy in the world, if not understood, and then blessed by the other attorney, accountant, advisor, family members, the clients they're not going to move. They just, because they don't get it. And so I think that's the big piece here. And so on that side, has anyone had either a good experience or a bad experience when it didn't work because of what did or didn't happen here? When you've worked together, have you noticed a difference working with attorneys, accountants, the advisor, the foundation person?
Yeah, just simple example, doing qualified charitable distributions from IRAs and the accountant not being aware that, because the 1099 doesn't say that it's a qualified charitable distribution. So they weren't aware of it, and the client gave $50,000 away to charity, but the accountant had it as taxable income. So that was just a communication issue.
What about the foundation people? When does it work well?
Yeah, I think it works well when you have, us and the planner, because we know our charitable stuff. And I will readily admit that when it comes to getting in the weeds of some of the things, that you're going to be talking about, that's not my area of expertise. So I want someone there who can help with that and really help explain that and make sure that the potential donor is just really clear on how that's going to work from that perspective.
I think one thing too, especially for foundations or for the beneficiaries, is making sure that we know the intent of the donors. That is so important, and also endowment levels, because when I have an individual that is giving in their estate plan, I need to know what the dollar amount is, and if it's going to qualify, and I run it through all the calculations to make sure it qualifies as an endowment by the time their expected lifetime is over. So I think that's a super important thing, and when we can work together, it makes it a lot easier for the donor as well.
Yeah.
They can realize what they can do, the impact they can have.
So now as we move into lastly the psychology of giving, I want to talk to you about the psychology of money. And this is a slide that we have in our firm, but you ever heard of Maslow's hierarchy of needs? Okay, it works the same way. And we find this with financial security on a lot of items, but you notice the top of the pyramid there is leaving a legacy, right? And it says up there that, legacy is about the impact you'll make on the people, charities, and causes that are important to you. Okay, so that's where that is. But you need to do the bottom first. And so people need to know how they're going to pay the bills. Essentials are the necessities the monthly expenses that keep your life running. Well, it also means that you're confident in cash reserves, confident that you have enough money. And so once you know that you've got your bases covered, you can start to think about other things. You know, if a person doesn't have food, water, clothing, shelter, they're not really friendly, right? But once you do, you can have family. And if you have family, food, water, clothing, and shelter, you can have friends. And if you have all three, you can have goals. That's Maslow. The same thing works here, is that if clients are confident they've got all of the bases covered, and they're going to pay bills forever, they're okay, then they can do the lifestyle things, right? The new retired person that wants to buy a boat. Can I afford to go away for a month? Can I afford to do this stuff? You know, it's about the things that you want to do and how you want to live today and in the future. And if you can do both of those and you've got it, you're confident of that, well, then you're still going to worry, right? So and we're going to talk a little bit about this further, unexpected things, you know. What about someone passing away, a spouse passing away? Can you afford to live on the income that's left? You know, what happens if you go to a nursing home? Can you afford to do this stuff? Can you imagine if you know that you've got enough money to live, enough money to do fun things, and that you don't have any concerns about protection needs, right? Well, then how difficult is it going to be for someone to say, hey, you know what, we're doing a capital campaign, you know, do you have any money? Well, the person is going to be able to then think about all that stuff quickly because it's done and go, yeah. And so, of course, I can think about this. But if you're trying to get somebody to give, they're going to go through all of this stuff. So if somebody if we want to do something, if our family wants to take a trip, I need to know, is the bottom covered? You know what I mean? You know, if we hear that a friend of ours is sick, which one is, I'm going to think, are we okay? Right? So at any one of these levels, I think it's important to know the psychology of where people are at and how they make decisions. If you do, you can get it done. So to me, that's a big deal. So let's break down. Let's break down my world. So what is financial planning? Well, the CFP is from the financial CFP Board of Ethics and Standards of Conduct, straight off the website. The slide is, and I highlighted a couple things here. What is the definition of financial planning? And so financial planning is a collaborative process that helps maximize a client's potential for meeting life goals. Think about that. Our job is to help clients maximize their life goals. Well, that means we got to find out what they are. And they may not even know what they are, right? And if you can, then to maximize it, right? So it's not just doing a gift. Maybe it's giving the whole IRA away and replacing it. You know, there's a lot of ideas that can happen to help people think about this that is good for business for everyone, but yet can help these people do this. So I think that's neat through financial advice that integrates relevant elements of the client's personal and financial circumstances. So that is what is financial planning. The next is, I thought this is interesting, but what are relevant factors to consider in financial planning? So what are we supposed to consider when we're helping people do this? Well, if you just go to the bottom, right? I mean, obviously we talked, it's to develop goals, manage assets, liabilities, manage cash flow, identify and manage risks, identify and manage the effect of health consideration, provide for education needs, achieve financial security, preserve and increase wealth. Well, if you have concerns about any of this, are you really going to sign up to give about $100,000 away? Right? So that's got to be figured out. Then it's to identify tax considerations, prepare for retirement, pursue philanthropic interests. How about that? And to address estate and legacy matters. Well, apparently we have a lot of work to do. If you're a CFP, you have a lot of responsibility here. You know, but how cool is this to help people do this? You know, how many people today don't feel satisfied, right? Don't feel confident. You know, I mean, this this is going to cure a lot of people from going to, a counselor talking about things if they would just find out where they are, see what they need to do, and then think about goals. But it's up to us to help them get it done. And I think that's a neat thing. And I think that, but these are relevant factors to consider. So what's the financial planning process? And so for you that aren't CFPs, this is what we're supposed to do. Sometimes you work in an area, but if you don't do all of these things, the CFP Board of Standards says you got to tell them that you're not doing it. So if someone just wants to work with you in investing, you got to tell them, I am a doctor for money, but I'm only looking at this one thing. Because we are actually liable, whether we charge or not, for looking at all these things. You can't ask a doctor not to look at somebody and have them not think about the whole thing. So there's a lot of responsibility, but if you do this and you take this as your passion, it's great. There's no risk because if you do the right thing. So I highlighted some of the areas here though. So number one, the first thing that should happen in the planning process is to understand the client's personal and financial circumstances. What would that mean to you guys? What is understanding their personal and financial circumstances?
What's their earning? What do they have coming in for income?
Yep, find out where they stand. What do you think personal circumstances means?
Family liabilities, they may be under the rug, whether it's a parent, grandparent, child,
Right.
that may need some help.
Yeah, what's going on?
Yeah.
What's going on here? Right. Yeah, and because obviously if you don't know this, right, you're going to run into something, you're going to trip, you're going to fall, you're going to make a mistake. You need to know how the client's doing, Then obviously the second one says identify and select goals. Third is a big part. I think this is huge. Analyze the client's current course of action and potential alternative course of actions. So analyze the client's current course of action. It's just tell them how they're doing. Do you have enough? Do you not have enough? And we're going to talk more about that. And then potential alternate courses of actions. It means if it doesn't work, they might not like it. Or if it doesn't work, there may be another way to do it. 4, develop the financial planning recommendations. So guess what? It's our job to come up with recommendations on how to do this stuff because they may not be getting it from other places. Present the planning recommendations and then implement. And I think this is the key point here is implement. It's our job to help people get it done. And so I think that's a key thing. So if it's charitable giving, it's our job to help them get it done. But how do you get it done? You got to go work with people. You got to work with the accountant, you got to work with the attorney, you got to work with the foundation person, you got to work with the charity. We've tried to give money to small charities before, and we had to help them set up a brokerage account to get them to transfer the money. Because our client's the treasurer, so you got to help them get it done. Okay, so this is where I think, as we talk about this, this slide right here means a lot, and I think this is important to discuss. We're going to talk about the 7 key areas of financial planning. There's 6, but there's now 7, because that's employee benefits. Case analysis, and I think this is why I want to talk here a little bit about strategies. What do we discover? What do we learn? And what do we tell the client in each of these areas as it relates to potential charitable giving? I think this is the key here. Because if we're looking for opportunities, all of these areas are going to create opportunities or pull opportunities away if they're not covered. Because the goal here is how do you get clients to give, right? Even if they want to, they may not know how to, they may not know if they have enough, as we talked earlier. And then we'll talk about strategies and opportunities. So, the first one is identifying, your current financial situation, net worth and cash flow. Most people have not put together their own net worth. They don't know how much they really have in all the places. By the way, they may not have seen They haven't looked at a detailed statement. They may not know how much they have in IRAs versus non-qualified versus Roth or other tax-free areas. What do you mean? There's different types of assets to have. And it does make a difference. Is the client cash flow positive or are they not cash flow positive? Right? I mean, that's a big deal. And maybe they have a lot of money, but they're not cash flow positive. Well, that means they're just not set up right. You know, they're not cash flow positive, but they don't like spending money, but they got a lot of money. Well, maybe we help send them some money on a monthly basis that would help their mind to have some ease, so then they can figure out, go to number 2, retirement planning, and find out they got enough money. This, I think, is key. There's a chart that a lot of financial planning software will do in a retirement calculator. It's the picture where it shows you how long your money's going to last. And does it go like this? Does it go like this? Or does it go like this? Right? Sometimes a client will say, well, how long do I have to live? Right? Because they want to make sure how long the money's going to last. And I think it's up to us to back test this. Because, normal planning software, we have a couple versions that we can use, but may say it'll be maybe based off their current portfolio's potential rate of return. Well, what happens if we don't have that? Right? So I think back testing the retirement scenario to help people figure out what's the lowest rate of return you can get and still make it. What happens if you spend 25% more money? What happens if inflation is higher? And looking at all this so a client can get a good sense of how much money they have and how much money they don't need. And that's a big one. And you have the ability in planning software to take assets and not earmark them, right? And if your planning software can't do it, you can change the number and put a 0 in there, right? If you didn't have these assets, would you still make it? And that works for all goals for clients. But I think that's a big thing because people just don't have enough confidence in their financial situation. And if they do, they're going to move. Yes, Matt.
I think that's probably where the disconnect earlier, where you run into problems, comes from. Is we may map it out well, but if it's the CPA or attorney that says, well, if I tell you to do this and you're out of money, you're going to be mad at me or you're going to be mad at them.
Yeah.
If you're able to model that to say, if we took this off the radar completely and you had 0 in there, you still make it into perpetuity, however long you live.
Yeah.
We can sell that strategy a lot easier
Yes.
with being able to say, today I feel like CPAs, attorneys are like, we've had a great market for 10 years. What if that's not a great market for 10 years and now you run out of money?
So I think that's a great opportunity to have somebody come in your office.
Yep.
And have another professional sit in front and actually see and look at the software together. Or family members or whomever, is that whoever it takes to get it done to help the client feel confident. Again, we're not really trying to sell people to give to charitable giving. It's identify if there's really a need, and to create value, you can help people brainstorm and think about things, and they don't know about the other options. So then we flow into, so bottom line is, obviously for a lot of things, if a you'll give different advice if you truly knew the client didn't have enough money, or if they have just enough, or if they have an abundance. And there's a lot of different ways to do some charitable giving. Now, let's say someone doesn't have enough money, right? Or they're gonna run out of money at 100. Well, that means their assets are gonna go down over time. But they might have something left over early. So what kind of a gifting strategy could you do that could be meaningful, but not hurt the client? Well, the answer I would have, that's where an estate gift comes in. It's whatever's left. Have that go, right? That's okay to give it at the end of your life, too. You can't afford to give early because they might run out of money sooner. But if they happen to go early or have whatever is left over or part of it can go over, you can still find a solution even for a client that is maybe doesn't have enough money to make a big impact, but they can make a bigger impact at the end. Obviously, just enough, or if there's abundance, then you have the ability to do more now. So the next one I think is interesting from a planning standpoint is investment planning. And what would I mean here? Well, really taking a look at what is their assets made up of. And even to the point where you take a look at non-qualified money and say, okay, so what kind of assets here have high capital gains? We have a client that gives a fair amount of money, a lot of money annually to their church. And it's a big number annually, but they were given cash. And then because they have extra pension, their John Deere pension is more than they need. So they're just giving it away. But they get a large non-qualified portfolio with a lot of capital gains in it that they're not using. Well, we're actually helping them come in quarterly, look at the portfolio, and we're transferring out the highest gain assets in their portfolio, stocks or ETFs or funds, whatever has the most gain, give it away. And then have them write you a check for what they were going to give and rebuy it. In most managed accounts, it doesn't cost a trade to the client. So how about that? Or if it's in a big managed solution, the manager will rebuy it if they like it. So it's a great way to give money away. And when a client needs liquidity in the future, they're going to have a higher basis. So I think it's digging around and looking for this stuff. It gives you a little bit more value for the advisor. It gives you more value. We do this with QCDs. There's great value there. You could do it in these other areas, but that's just giving to a charity, giving to a church. On a regular basis, you can do a lot of neat things, but you can't do it unless you know what it is. So by actually taking a look at their statements and looking at their liquidity and actually looking at where all the gains are at, do they have too much money in IRAs, or they have a whole bunch of savings bonds? What do they have? And it'll start to speak to you if do you have too much, just enough, or not enough. It changes all of this as you look through. Obviously, estate planning strategies. Well, the clients may have goals here. They may have goals that are not developed. And so this may develop over time. The goals that people have right when they're retired are probably not going to be the goals that they have when they're 85. And they're going to develop over time. But I think it's important to visit this stuff and dig in. We're halfway through the circle here, right? Don't you feel kind of tired? Like there's a lot you can do. Well, that's why planning is a process. It is. And so it's meant to be done over time. It's not meant to get everything done right away. It's okay to charge somebody a fee to get it figured out over time and get things done to take care of them. So then tax planning strategies. Well, okay, so what are the current tax planning strategies they're using and how can they be maximized? So, should you be doing a Roth conversion or should you not? Well, why would you not want to convert money from an IRA to a Roth IRA? Well, if a couple's going to give the money to charity because they don't have any children, why in the world would you want to pay a lot of taxes today if nobody's going to pay taxes on it later? So that's kind of an interesting thing. Well, taxes might go up later. They're going to have large required minimum distributions. Well, we can look at that and see if it really makes sense. But when you start taking tax planning can be in competition with estate planning. We could be financial planners can be tax efficiency nuts. Make the most money at the least rate. But maybe having not doing a cool Roth conversion is what you should do because they're going to give it away to charity. I think that how you give before 70 and a half and how you give later is something because you're going to give non-qualified money before to a charity, but jeepers, when someone's 70 and a half, you definitely ought to be doing direct charitable gifts. to lower that AGI. There's a lot of things that start to happen when you start doing these things. And I think it's important to know the impacts of this stuff and tell the client what are the impacts. So the next one, insurance planning. Okay, but what about insurance that has to do with charitable giving? Well, it's called, clients here get advice from everybody, and they'll say, well, should I get rid of my life insurance? Or why would I want to have life insurance? Well, actually, if you have a bunch of insurance you don't need anymore, maybe you should keep it. Why? Well, if you have extra insurance and it's going to make it, it's paid up, or it's not going to crash, it's going to be around until you pass away. I had a client that had $500,000 of permanent insurance. They were thinking about cashing out and getting rid of it. What we ended up doing is we're going to give $500,000 of their IRA to charity when they pass away, and their kids are going to get the insurance. So there's lots of opportunities here. You're in the protection area in insurance planning. Okay, how comfortable is a client going to be trying to do a lot of charitable giving when they're in their 70s and 80s if they don't have long-term care insurance? Right? But how comfortable are they going to be if they know that they're in life care at Friendship Village or at the Western Home communities now with Fortified Life, or having long-term care insurance, or a life insurance policy that has a long-term care benefit on it? If they know that backside is covered, how much more okay are they going to be than doing something charitable? So Maslow's at work here again. It's really about how the client can feel confident that they can make a step out and then not be hurt, right? And make sure all their bases are covered. Employee benefits. Well, this is an area for pre-retirees to make sure you look at, just to see, are you maximizing this? Because if they don't have disability insurance, they don't have life insurance, they don't have this, how are they funding their retirement plan? What types of retirement plans do they have? Do they have stock in the retirement plans? Are you going to do a net unrealized appreciation move when they're done, and then all of a sudden you've got capital gain, and now you can transfer shares to a charity or a family someday? There's just a lot of things to see. But if you really knew, in summary in this page, if you really know what's inside of all of this, the case analysis, right, really needs to happen. And then finally, the strategies will present themselves to you. Because as the advisor, you got to think about this stuff. You got to come up with ideas. And if you share the facts and circumstances of these areas with the other professionals, how many attorneys know what their entire financial breakdown is for the client? Do they know that the client has not enough money, too much money, or just enough? If they knew that, would they give a different recommendation? Would they bless your recommendation easier? So to me, I can't give any advice on anything unless I know all that. I mean, it's like a doctor looking at somebody and not wanting to do overall physical. So, okay. So let's just talk quickly then about specifics then. So charities, if we're going to think about this, and I thought about leaving this in there or not, but I think this is interesting. Have you all looked at the other side over there and what clients would like to give money to and write it off, right? Can I write it off to my son that just can't get it together? Are they charitable? No, they're not. You need to be a 501c3. And so I think that's interesting. Now, charitable, what is a charity? Obviously, pledges and beneficiary designations are not charities, but they can be a charitable deduction at death, right, for estate purposes. So if the charity is going to get it, but it's just not a current gift for a charity. So you can look right at the IRS, and you can see what are charitable places. So there's a place to go to. So tax deduction rules. Well, obviously, with the Trump tax cuts until 2026 or who knows when, right? That the standard deductions got big. I've heard this, and it's not the case. They did not get rid of ways for you to be able to deduct. The deduction is still there, it's never changed. The only thing that's changed is that people may not itemize, so they're going to get a larger standard deduction, and their standard deduction might be larger than what they give. But it doesn't mean that what they're giving is not deductible. It is. The standard is just bigger. So this is only good for 2025, 26. We go back to the rules where it's going to fall in half or so. So, but I just think that's important, but it does create an opportunity. So what would that opportunity be? Well, maybe a bunch. You know, if you've got highly appreciated John Deere stock that you have, but that you really want, right? Well, maybe you could give, if a client gives away $12,000 a year to their charity, their church, or whatever, well, maybe they ought to give $36,000 or $48,000 worth of 4 years worth of stock to the charity and do it up front. Then all of a sudden they're itemizing now a lot more. So now it's the same money, but they were going to do it. You could open up a quasi fund, correct? Here, or a donor advised fund somewhere and put it in and write it off in 1 year. And then when you are just getting the standard deduction later on in years, then that's when you're just peeling it out. So I think where we run into a roadblock, well, there's an opportunity too. So anyway, that's so as you look at this stuff, but if you knew the client situation, it wouldn't be a problem. It may be an opportunity. Okay. So, and sometimes I think that there's different rules for donor advised funds. There's different rules for charities. So I think it's important that you take a peek at that and you're aware of all of the rules when you're trying to set up all the neat things out there. But and then this is an interesting one. So the contribution base. So gifts of capital assets like stocks, bonds, and real estate are generally deductible. But if they're highly appreciated, then it's only 30% of AGI. So deductible of that amount. But there's also, they changed it to 60%. Because the Jobs Act went from, in 2017, went from 50 to 60% of AGI. And in 26, it's going to drop back to 50. So it's important to know this. If your income's too low and you have deductions or that you can't use, then they can carry forward. So we had clients that did a capital campaign to a church a number of years ago, and they gave $300,000 of UPS stock away. Had no basis in it. Used to work for them. Okay, well, their income wasn't high enough to write it all off in 1 year, but then that's fine because we used it up over time. And so but they wanted to make this large gift. It was okay. They had the money, they needed it. But then we got to do Roth conversions for the next, 4 years. So, they could afford to do it. We know what the tax situation is. It's okay that we didn't get the 100% write-off for 1 year, but then we used it up as we went. And so that tax deduction, that capital campaign got them to have, 100 to 200,000 more Roth conversions over the next 5 years. Because we decided that we got them low and we could get it all into the 15 and back then in 0% tax brackets. Okay, so you see how you create these opportunities, but you got to know what the situation is. Okay. So, and here's an example. So $100,000 goes to a local museum, 30%. The 150 is 45, but you're going to have a carryover forward because your AGI is not high enough. So, okay. And just some ideas here. Obviously, you can give cash, you can give assets, and you can give insurance. So what are strategies? Well, actually, cash is cash. So if you write a check, you get to deduct it all, right? That's the most common giving, and you can. It's 100% deductible right off the top. Appreciated property. So if you want to give away 20,000 with a basis of 8, the basis goes. One thing that just got to remember on giving, it's got to be long-term capital gains. It can't be short-term. So if you're thinking, hey, I looked at their brokerage screens and hey, there's an account in their managed account that's a position that's got a lot of gain in it, transfer it away. Well, you've got to look and see it's got to be long-term capital gains or it's not deductible. So you got to pay attention to when you're starting to implement. But anyway, so adjusted gross income is 50,000. The deduction would be 15,000 because of the 30%, and so it carries forward 5,000 the next year. Now, we talked about this, so you can, if you give life insurance, you can name a charity as a beneficiary, but knowing, so if you name a charity a beneficiary on insurance or even an IRA, it's no income tax deduction, but it is going to come off the estate. And there is going to be no income tax if it's an IRA. Even though we're just talking about life insurance, I think that's a great way to give money away is to use retirement assets. So if a client says, hey, you know what, I want to give some money, I want to give 10% of my estate away when I pass away. Don't do it in the will. Look at their accounts, and you're want to do that from an account basis. It can't be a dollar amount on beneficiaries. It's got to be percentages. So it's like 100% of this asset or 50% of this asset. But give the non-qualified annuities away. But give the IRAs away, and that comes off and let the family inherit the non-qualified stuff. And a lot of times the will doesn't know what they have out on beneficiaries, so you give 10% of the will, what's in the will, and the only thing that's running through the will is the house and the cars. Their 401k has a different beneficiary. You never got to go. So, and then obviously to give life insurance, to get a deduction for life insurance, it has to be an owner, and it needs to be ownership changed before it's gifted, like when it's new. Otherwise, you get gifted. So, and that's how that works. So donor puts money into a life insurance policy, the proceeds go to a charity, or the donor gives money to a charity, they own the policy. And then the contribution can be deducted. So, and I think, okay, we talked about health, right? Well, their personal circumstances makes a big difference if someone's insurable or not. They may want to do things, but they may not be insurable. You may have to go another route. So it's important to know the health of a client. As we talked about testamentary, obviously you need to pay attention to the net worth to see what's going to go through the last will and testament or revocable trust. So it's important to partner with the attorney that you're working with so they know what the net worth is made up of. And lastly, I think this is a unique thing. If it works with life insurance, is to be able to help clients give money away through a beneficiary. But if they didn't want to not give money to a charity, but they want to give it to all of their family, well, if they're not using some of these assets, maybe they can use some assets to buy some insurance to replace the retirement plan, and you give both. So instead of $500,000 go to the family after taxes, which was $350, now they get $500 tax-free, and the charity gets it tax-free. So instead of giving $350 net to the family, $400,000 after taxes, $1 million goes two ways. So the qualified charitable distribution is monumental. I think this is big. It's a big, I think the most qualified charitable distributions that we did for a client is in the 50s. Like 50 of them. That's 50 pieces of paper, 50 electronic signatures, right? What kind of value is that, right? You know, and so, you know, our value as advisors can be doing work for people to get it done. You know, you just got to charge people enough to tell them the truth and get the work done. So, but definitely should be a strategy that's looked at. Now the new 72 rule is different, right? Because, you know, you don't have the income to write off, so you got to look at, you know, is it worth it to use IRA money at 70 and a half and not get the deduction for it? Probably, but it's something to weigh. You know, or do we take it and do we use other assets and try to itemize? So, questions? Don't call us. Call the tax professionals. So that's all I have. Any questions? And we're about out of time. So, any takeaways? Questions? Great.
Thank you, Eric.